CommitToWealth.com, creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas, bringing you yet another awesome guest to the podcast. So our guest today is Kevin Bupp. If you haven't heard of him, a little bit about him. Kevin is the co-founder of Sunrise Capital Investors, through which he has acquired and transacted on mobile home communities with a transaction volume of over 100 million. He is the host of not only one, but two top-rated podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcasts. Two podcasts that I listen to, by the way. He has been investing in real estate since the early age of 20, and he has not looked back. Kevin, welcome to the show.
Juan, thanks for having me. Very much looking forward to it.
Hey man, it's a pleasure. So like I said, I listen to your podcast, so it's crazy for me to be interviewing you. But yeah, it's my pleasure. So, I went through your background just briefly. So I always like for my guest to go into more detail and kind of tell us who that person is. So who is Kevin Bupp?
That's a great question. I'll try to keep it somewhat condensed to be respectful of everyone's time. But, I simply grew up in a very blue collar family, didn't go without and didn't have too much, right? But it's all relative, right? Like you don't know what you don't know. And so, but I had a good upbringing, grew up in Pennsylvania, a small little town in Pennsylvania. And, just really worked my way at a young age to make my own money to afford the things that I really wanted. I, cut grass and shoveled snow, those types of things. Got a paper out at the age of 12 when I finally was old enough to get one, and just basically always wanted to be able to kind of support myself. I knew my parents worked hard. They didn't really have a lot of extra money. And there was always, when you're a kid, you have certain things you want, remote control cars or dirt bikes or bicycles or whatever it might be. Right. Mm-hmm. And I wanted to be able to kind of pave my own way. And so I've always been one to just figure out a way to kind of make my own way and support myself. And so, moving through high school, I did a lot of odd things just to, kind of hustle and make money. And then I graduated with not a lot of direction. I didn't know what I really wanted to do with my life. I was confused because academically I struggled in high school. I didn't enjoy it. I'm very much a learner today, enjoy that process, and I probably would going back. However, then I didn't understand the point or the benefit behind it. And so I was just at a very confused stage in my life. Just instead of going away to school like a lot of my friends did, I opted to go to a local community college, more so because I didn't want to waste my parents' money. I didn't want to, go party away at a university and blow their hard-earned money because I wasn't able to take it serious yet because I didn't know where I wanted to put my energy in my life. And so during that stage, I guess I was a sophomore in a local community college, attending bar in the evenings to make money. And I was introduced to a guy by the name of David, and David happened to be dating the mother of a girl that I was dating at the time. So kind of a strange story how that all came together. But Dave was a local real estate investor. He owned single family and small multifamily properties. He lived a very different lifestyle than what I knew growing up. And he was a great guy, nice guy. He was about 25 years my senior, but we kind of clicked. Every time I saw him, mm-hmm. I noticed that he dressed really nice, drove a really nice car. And he was always around at the odd hours, like when you thought adults should be working, right? And it was just kind of interesting to me that he had this flexibility in his life. And I thought that was pretty cool. So in any event, a couple months into our friendship, he invited me to a real estate boot camp down in Philadelphia. I had no idea what he did. I mean, I'd never considered real estate. It kind of found me, right? And I think he just saw like the struggling, 19, year old that didn't really have direction in life. And so he invited me down to this 3-day boot camp that he had spent, $3,000 or $4,000 for. And so I thought, if that was the only reason that I should go, because he spent a ton of money and he just invited me. So there has to be some type of opportunity here, right? Why wouldn't I go to check this thing out? Mm-hmm. And I went. And what I did there, or what happened there, was I met a lot of people that were making, creating a great lifestyle out of investing in real estate, many different forms, but very similar to what Dave was doing. A lot that were fixing and flipping, right? But I kind of got exposed to a ton of different things there, and I was intrigued. I was overwhelmed. I had just a lot of emotions rolling through my system, but ultimately, I knew that I felt that it was something that I could wrap my arms around, because the people I interacted with and met, I didn't feel like they knew more about real estate than I did at that time, but I didn't feel like they were any smarter than me. I didn't think that their intellect was larger than mine. And so came back and offered, basically to David, why I asked him, I said, I want to do this, but I don't know where to start. You took me this thing, and it's overwhelming, but I don't know where to start, but I want to learn what you do. And and just really asked him, how can I help him? Is there anything I could do to help him in his business, so that I could spend some more time around him on a regular basis, to just through osmosis kind of learn what it was he was doing and understand how to really make money in his business. And he accepted. And so for a little over a year, I became, I don't know if I had a title really, but admin assistant, coffee go fetcher, whatever it might be, but I did whatever he needed so that I could be around him. And so that was my first kind of real involvement, just being surrounded by real estate on a daily basis. And took me about a little over a year to feel comfortable to buy my own property, and did it with the bartending money I'd saved up. David didn't pay me. I didn't ask him to pay me. But I got paid a lot just by the education that he had given me. And so I bought a property at the age of 20, and made money from it. Bought the next one. I modeled what David had done in his business. I didn't know anything other than his business model of basically he bought with the intent of holding for cash flow. I couldn't do that from the very beginning. So I'd have to buy, fix up, and flip a couple properties or wholesale them, and then try to keep on. And then kind of rinse and repeat that same process until I had enough of a war chest where I could start holding more properties for the long term. And so that's what I did. I started my, again, 20 early age. And I did what I knew, again, what David had taught me. And I ultimately built up a pretty big portfolio in my early to mid 20s. And that carried us through 2008. I had some challenging times during that period. Lost pretty much the entirety of my business, a few hundred properties, and had to start back all over again. And so 2011, jumped back into real estate. 2012, bought my first mobile home park after being introduced to that niche, and haven't looked back since. And so 2012 to present date, we've been actively focused in the mobile home park space, buying properties throughout the country. Today, we own properties in 13 different states, and are actively buying today. So it's been a kind of a 180, turn from beginning, losing it, going back again, rebuilding it, and I guess you could say it's a 360, right, from beginning back to the beginning again, and then ultimately rebuilding something that was much more sustainable than that of years past, prior to the 2008 crash. And so just been doing it full time ever since.
Nice. I love the story. Yeah. I really do, because, it just goes to show that, you can do a lot, and you wouldn't even get paid, right? You had this mentor, I guess you can call him your mentor. He wasn't maybe officially your mentor, but he wasn't even paying you, and you were still working on the side as a bartender. I think that's what you said, right?
Yeah.
And you saved enough money to get started in real estate. But that's one of the keys, right? And this is kind of getting a little off topic here, but I think that's one of the keys that people need to focus on as well. Is, you don't always have to get paid for what you're doing. Is if you're learning a lot, that right there, like you said, it came from your words as well. That is enough pay in itself, because
Absolutely.
you're learning the education that's going to help you to be successful, right? So that is worth its weight in gold.
I mean, it's invaluable. I don't know where I'd be at, Juan, if it wasn't for meeting David. I really don't. I had no idea what path I would have taken in life. I'm sure I would have turned out okay. But, I'm very grateful and blessed that David came in my life at that point in time, right? Everything happens for a reason, right? It's just all about being prepared for when those opportunities present themselves in your life. And so back in that day, I mean, David was that opportunity that presented himself, and I grabbed a hold of it and didn't look back. So
that's the way to do it. That's the way to do it. So you talked about, 08, right? And I'm kind of going back here a little bit, but what was the difference in the type of assets that you had then versus what you have now? I know your bigger focus right now is mobile home park or mobile home communities, but what type of assets were you buying then?
Yeah, most of our business revolved around single family rentals. I did have a portfolio of multifamily, smaller stuff, 12 unit, 24. The biggest one we have is like a 72 unit. But the strange thing about that is that our primary core business were single family. We had a big, operation going, and the multifamily stuff was kind of like I don't call it a side hobby, but like we put money into properties that were brought to us, but we never really put a huge emphasis on building that side of our business. However, when the downturn happened, the major efficiencies that were exposed in our business were pretty much on the single family side. And I think they had been exposed prior to that downturn. It's just, you get stuck in this complacent state of we had this big business, we had built a lot of structure in place, and the system was moving forward, right? It was moving forward until it wasn't moving forward anymore. Mm-hmm. And we didn't address a lot of the inefficiencies that were there. If we'd have been honest with ourselves, we would have pivoted probably a few years prior to the 2008, not knowing that it was coming, but we would have just pivoted our energy and taken it from what we had done in multifamily. We would have taken some time to push pause and actually pivoted into multifamily because it was a night and day difference of how efficient that side of the business ran versus the inefficiencies of managing single family properties that were spread out amongst 3 different counties, doing maintenance and repair on properties that were, in 3 different counties, and, doing leasing on properties that were in 3 different counties. I mean, it was kind of chaotic, probably the best way to put it. And so in any event, we knew what was wrong. After the crash happened, we kind of were honest with ourselves and said, gosh, we should have really, we should have changed gears and went after multifamily. There's so many positive aspects of multifamily, with multiple roofs underneath one location, underneath one building. Financing options are much better in multifamily when you start looking at bigger properties than what they would have been in a portfolio of single family homes, right? And so that might not be the case today. Single family, has come a long way. It's a much more recognized portfolio asset class than what it was back then. Back then, the terms weren't nearly anywhere near the terms of what you might find in like Fannie or Freddie agency type debt that exists today. And so, in any event, that's kind of, that's a little background.
Yeah, good. Yeah, definitely the terms have changed. It definitely has become a pretty good asset class. But still, there are other asset classes that we like, and one of those is specifically mobile home communities, right? Which is what you focus on today, right? So, tell us a little bit about your first community that you bought, and I think you mentioned that it was 2011, 2012, somewhere in that time range. So tell us a little bit about the process. What it looked like, the price range, the size. Anything you can tell us about that.
Yeah, so I started a few other side businesses. 2008 happened, and it was I was in very defensive mode for a number of years. I mean, it wasn't something that just went away overnight, and worked through a lot of challenges with properties I had, and just in any event, took a hiatus from real estate, started a few other businesses outside of real estate, and then the fire of real estate never really left my belly, and I was just in a defensive mode and kind of stuck inside my own bubble. Everyone I knew in Florida that bigger portfolios than I were all in like just a catastrophic state, right? Their businesses had been crushed, and so. In any event, 2011, I started really stepping back outside that bubble and realizing that there was opportunity out there that we were missing on, right? And everyone knows that old adage of like buy low, sell high, or buy when there's blood in the streets, and it's kind of hard to think that way when it's your own blood out in the streets. But anyway, I kind of got my head back straight again in 2011, started back on a journey again of just trying to determine how the landscape had really changed in real estate. Everything was all completely different. And when I say that I truly stepped away from it for a couple of years, I did. Other than managing, the fallout of my own properties, I didn't spend any time looking at opportunities, looking for deals, any of that. I was just in a very different mind state. In any event, I met a guy by the name of Randy in late 2011. Randy happened to own some mobile home parks local to me, as it was an asset class I'd never considered before. And I met Randy for lunch, not really with an interest of learning about his business, just to meet someone new, right? I just, expanding my network. I really had no interest in his business. I just knew what he did prior to meeting him. And at that point, I had already made the decision that I was going to rebuild with multifamily. That was where I was going to go because it was much more efficient. I could get back to where I was much faster than trying to buy a bunch of single family properties, right? And so after this lunch meeting, Randy, piqued my interest in many different ways of, why he chose that asset class, some of the benefits that he's seen with mobile home parks versus multifamily or other types of real estate, commercial real estate in general. And I was intrigued enough to leave that meeting and basically commit to the next year of learning as much as I could, but not just learning, but buying a property and either proving or disproving, what Randy had touted during those 2 hours together. And that's what I did. So 2012, towards the end of 2012, I bought a first property. We still own it today. It's in Atlanta. It's a small little 34 space mobile home park. So it's a tiny park. It's the smallest one that we have in our portfolio. Probably one of the most profitable, generally speaking, because we picked it up. It was a distress sale. It had been an REO for 2 years. It was about as bad as it could possibly get, but it was in a great location. And I basically sacrificed my, the next 8 months of my life, literally driving back and forth from Tampa, Florida, up to Atlanta, back and forth every week to manage multiple crews, rehabbing the units, releasing, reselling them, and getting that place stabilized. And it was a major uphill battle, but it was one that proved to be really successful. And so at the end of those 8 or 9 months, once we stabilized that property, I again, had kind of proven that what Randy had told me on a small scale, at least it worked. And so we were going to go out and buy another one. Right. And so then the momentum kind of started. We bought our second, third park within the following year, and then went in a much bigger scale, like the third and fourth year. Really started to buy multiple properties at one time. And today we've got 19 properties we've bought and we've sold, here and there. Today we've got like 3 properties in contract to sell. And so we're not necessarily sellers. However, one thing that's changed with us over these years is our portfolio has kind of evolved. We've evolved from maybe buying smaller communities and more heavier value add stuff that takes a lot of heavy lifting and bandwidth to buying more, core type assets that are on the stable side, B plus or A class assets versus C minus assets, that type of thing. So we've been slowly kind of working through our portfolio and just not necessarily cleaning it out, but again, refining it so that we can, continue to buy high quality assets that create long-term legacy wealth, things that we can hold on for 10, 20, 30 plus years. Right. And so that's just the general premise of kind of our introduction into where we're at today. And it's been what we've done. So I do this full time. This is the only thing I do outside of, we talked about before we got on the show here. One of the other asset classes that we're moving into is parking lots. And so got a couple in contract now, don't own any yet, but it's another asset class we're moving into, but we are full-time investors.
I love it. Mm-hmm. So what do you look for specifically in a mobile home community today? Like what automatically doesn't cut it, and what will you look further into?
Yeah, I mean, just very initially, like from a high level perspective, is the size. Mm-hmm. Really, we're looking for parks that are 80 to 100 units or larger in size, for many different reasons. Just efficiencies, the different type of debt that's available. As we had mentioned about agency debt and multifamily, well, it's very prevalent in the manufactured housing space as well. However, they're looking for minimum loan amounts of $2 million, and they're looking for higher quality assets. And so, typically, the smaller communities that you find out there, the 30, 40, 50 space communities are much more mom and pop. I'm not going to say typically lower quality, but the majority probably are. They wouldn't necessarily qualify for Fannie or Freddie type debt or any other type of non-recourse debt. And so, again, just from a high level perspective, the size is the first thing that we look at. After that, we obviously look at the market, right? I mean, it's you can change the quality of a mobile home park or an apartment complex, but you sure as heck can't change the market that it's in. And so we want to know that, number one, there's a demand for affordable housing. Number two, that it's not a declining in local economy. Like people aren't racing to get out of that area. We want to know that it's landlord friendly, which I wouldn't say we've made the mistake in the past, but we own some assets in a few not so friendly landlord states, and it's been an absolute headache. And so moving forward, we've vowed as a company not to purchase in any states that are incredibly restrictive to landlords that have rental units. And so again, from a high level, that's what we're looking for.
So what about communities where they are park-owned homes, right? And I know that's something that's a big topic. And then also on the other side of that, the utilities, either private or city. Mm-hmm. Can you tell us a little bit more about that? What you look for?
Yeah, no, that's a great question. So as far as like a park-owned home, so just for folks that are listening, a park-owned home is any mobile home park is, when the park owner actually owns that unit and has it as a rental, right? In a perfect world, and how mobile home parks were traditionally built and developed, years and years ago, was that you as a developer developed the infrastructure, put in the roads, put in the sewer and water lines, electric, what have you, and that consumers would bring their mobile homes in and rent that land from you. They own the home. They take care of their own home, their roof leaks, their plumbing breaks. That's their responsibility. We, as the owners of the property, simply collect lot rent on a monthly basis. So it's a very low maintenance type of business. However, over the years, things have changed. A few factors. Consumer financing has become more challenging for the end consumer that wants to buy a mobile home, and so that creates a barrier. Another barrier that you have that you're up against is you've got a very expensive proposition to move a mobile home from one area to the next. And so, through natural attrition, you've got folks that, that live in a mobile home community that own the unit, they get transfer of a job, or they have to leave the local area. They can't afford to move that mobile home. They don't have the ability to move that mobile home, nor do they want to. And so being a park owner, we don't want that home to leave the park. And so a lot of times we'll buy it back to keep it there, and then we'll have to either resell it or re-rent it. And so just through the course of normal business, you end up owning homes. It's just the nature of the beast. It's not the most favorite part of the business for us, but it is part of it. And so today I think it's about 12 to 13% of our portfolio. We actually own the units. And we don't do normal rentals. Our goal is to get those things off our balance sheet and to get them out from underneath the maintenance of them as fast as possible. And so a lot of times we'll even lose money on one of those homes just to get a homeowner inside there. We don't want a renter. We want a homeowner that owns that unit outright, that's going to take care of the maintenance and repair of that unit. They're not calling us when their plumbing breaks or when the air conditioner breaks, what have you. And so anyway, just want to give the definition of what a park-owned home is. We're not opposed to them. Again, it's part of the business. We own some communities that have 0 park-owned homes, and we have others that have 20 or 30 park-owned homes. And so we won't shy away from a deal that has those in it. However, if we had a choice between one that doesn't or one that does, we would ultimately be more catered towards the unit or the park that has 0 park-owned homes. It's just much lower maintenance, much less turnover. And at the end of the day, one of the huge benefits of a mostly or entirely a park-owned home or a tenant-owned home community is the pride of ownership. I mean, these are homeowners that typically would resemble that of a subdivision, right? Most of them have pride of ownership. They're going to if they own the unit, they're going to take care of it. They're going to put flowers outside. Most of the time, they're sticky residents, meaning they stay around quite some time. Our average tenancy of a tenant-owned home is 12 to 13 years, and so and that of a renter, 12 to 18 months. I mean, so it's a very different type of individual we're dealing with. Transitionary, just not sticky to homeowner that's going to stay quite some time. And one of the other beautiful sides of if they own the home outright is, again, I mentioned it's very expensive to sell these or to move these homes. And so what happens a lot of times, if someone has to move or wants to move, they'll normally just put their home up for sale to the general public. And just like in a subdivision, someone, they're out searching for homes. They find a mobile home for sale. While that person's living there still, the original owner, they're paying the lot rent. They find a new buyer for it. That buyer gets qualified by our community. They get approved. They take care of the responsibility of that lot rent. The title of that unit changes hands. The ownership changes hands. We never see any type of gap in our revenue. It continues to come in. Whereas with a renter, you got someone that moves out of a unit. You got, number one, make ready period where you got to get that unit back ready, available for lease again. And then you got to advertise it, show it, what have you. You might have, a month and a half, 2 months of downtime, down revenue, in addition to the out-of-pocket costs of getting the unit back up to speed, right? So in any event, just some of the pros and cons of park-owned home versus tenant-owned home and what our preferences are. And you had mentioned also about the utilities, private versus public. We own both. And again, a preference would be public utilities, just less hassle, less potential future maintenance. But we do own some private, sewer systems. We own private wells, what have you. It's just really it really depends where the park's located. And one of our, requirements, if we're going to buy a park that has private utilities, it's got to be within connection distance of municipal utilities. And so if we're going to buy something, we need to know there's a plan B, because a lot of private utilities have a shelf life, right? They have a usable lifespan. They don't last forever. Septics or wastewater treatment plants or even wells. I mean, wells run dry. You got to dig a new well, go down to a different aquifer, deeper down. And so we want to know that when and if that time comes during our ownership, that we have the ability, if we want, and we choose to connect to municipal utilities. And so we will not buy a mobile home park that is not within a reasonable distance to where it's cost prohibitive to actually connect to municipal utilities.
Understood. So going back really quick on the park versus tenant-owned homes, how do you determine a resale value, right? Because a lot of these, they're in worse shape than you would imagine. Some of them are not so bad. Some are pretty good. But how would you determine the resale value? And if you wanted to sell it to somebody else, and how do you qualify that person?
Yeah, that's a great question. It's very similar to like a vehicle. Mobile homes are depreciating assets. There actually is like an NADA guide. However, you'll find that the value per that guide will range significantly from one, market to another, right? And from, for example, a home, the same model home, same year home that's available in, let's use Raleigh, North Carolina, would probably be much more expensive if that home was located in Orange County, California, right? It's just a much different type of buyer out there, different cost of living altogether. Someone's probably willing to pay more for it because that's the norm out there than what they might in Raleigh. And so anyway, the NADA valuation is one general rule of thumb. However, we simply just what we normally do as a back of the napkin, we'll just look on Facebook Marketplace or Craigslist and literally see what the rest of the market is selling for that general age range and size of home. And then we also factor in what type of repairs it might need, right? Because there's something that's move-in ready, and then there's something that if it was worth $20,000 and move-in ready condition, but it needs $10,000 worth of work, well then, I'm not paying $20,000 for it, because ultimately
for sure,
what you're going to buy into is a depreciating asset. More than likely that mobile home today will never be worth more, a year from now than what it is today, right? It's always going to slowly go down in value. And so, as I'd mentioned, we're very much open to losing money on a home. I'll give you an example. We just sold a home, I think, like 2 days ago or Friday of last week. And we had about $15,000 into it. We had a very qualified buyer come in, 700 plus FICO score, which is somewhat of a rarity in our business. Good steady income, long time at the job, what have you. And they offered us $11,000 on it, which $15,000 actually was a very fair price. It probably would appraise probably for like 18. I mean, it really would. We normally price these things to fly out the door. But she offered 11. I think we ended up at like 11.5, and so we've lost a good bit of money, $3,500 on it. But I know that tenant's going to be there for a long time. In addition, she's not going to call me when if the roof leaks or the plumbing breaks. Obviously, we sold her a good home, but like inevitably, it's used and things will happen, right? You'll have to repair things over time. And she won't be calling me for that, which is a good thing. So we've kind of taken that responsibility off our plate. We'll lose money to do that. And we found that $3,500 is a fair price to pay for us to forego that responsibility. So we do that quite often.
Good. Let's talk about efficiencies in expenses, right? So what are some of the ways that you can increase the value of your communities? Maybe utility bill back, maybe, charge, increasing the rents. I mean, I just kind of want to get a higher, high level view of what you can do to improve the NOI ultimately.
Yeah, no, you hit a couple of the big nails on the head. And I like to say there's high hanging fruit, middle hanging fruit, and then low hanging fruit. And for us, just like, very similar to the apartment space, the low hanging fruit for us is finding something that's been operated by, maybe a mom and pop owner or an owner that just really hasn't kept up the rents to market. Doing a lot rent increase is just it's the cost of, assuming you might have to do some improvements to the property to justify, but either way, that low hanging fruit is literally the cost of the piece of paper that you send the notice out on. And so that's incredibly low hanging fruit. And it's quite often in our business that you'll find mom and pop owners that are very below what the market rate is. They literally, I've seen people where they haven't raised rents in 15, 20 years. It's just insane. They're 50% below market or sometimes even more than that. And so we typically won't try to achieve that increase all in one given shot. We'll kind of draw it out over a period of time to make it a little bit more manageable for the residents, but that's low hanging fruit. So that's one way that is quite common to add value. And then the middle hanging fruit would be a couple different things. Number one, you mentioned utility bill backs. A lot of these parks, when they were built, 30, 40, 50 years ago, water and sewer just wasn't expensive. It wasn't something that a landlord or developer really worried about because it wasn't expensive whatsoever. However, times have changed. It's increased in price. And in addition, that infrastructure has become somewhat older. And so there's, more leaks and water loss, what have you. And so one of the things we'll do is we'll go in and basically install individual sub-meters at each one of the lots, and we'll respectively bill back their individual usage, right? And so the ones that were the abusers are the ones that very quickly, stop abusing, and the ones that were actually, really responsible about their usage get a big break because their bills, often they're going to pay only what they use. And so, but that goes directly to our bottom line. So we can go into, 100 space park, and for anywhere between about $30,000 to $33,000, we can install meters. So, go ahead and, $300 some odd dollars for the meter and the installation. We can basically sub-meter that water back. And, in a 100 space park, you're probably looking at an annual water bill of somewhere in the probably $35,000 to $50,000 range. And so just, you can do the quick math, that going directly to your bottom line as far as savings.
That's huge.
And apply, whatever, 6 or 7, whatever kind of cap rate you want to apply to. It doesn't matter. It's still huge, right? It's a big number. And so that's one of the ways. Another way is, which is like middle hanging fruit, is just operational efficiencies. Again, we deal with a lot of mom and pop operators that just aren't the best business people, or maybe they've just lost steam over the years. And so maybe their payroll is too high. Maybe their collections, they don't have a good firm collections process in place, and they're not recapturing or recollecting, 95, 97% of the rents each and every month they got. carrying balances that keep rolling forward, what have you. They got people that they're not evicting that they should have, that haven't paid for a long time. Again, the water and sewer thing's a big one. They end up having infrastructure issues that they haven't repaired, and so their water and sewer bill's out of control. And so we can go in there and fix all those things pretty quickly. We can normally identify all the inefficiencies just by looking at a P&L statement. Visiting the property and looking at the P&L can very quickly figure out exactly what's going wrong and what the quick fix is. And so again, middle hanging fruit there. And then the high hanging fruit, the fruit that is the most capital intensive and logistically challenging is, before we started this call, we were kind of talking about mobile home parks and developing versus, just buying existing. A lot of the existing parks that are out there today, what you'll find is that a number of them have, fully developed pads or lots, but they have no home on them. They might have the infrastructure there. Maybe a home was there at some point in time in the past, but it left and it never, no one ever brought one back in for whatever reason. And so what we typically will do, we'll go in the local marketplace, either buy a high quality used home and bring it in, or we'll go buy a brand new home from a dealer and bring it in and basically, try to sell it back to an end user. And so again, very capital intensive to do that, a little bit more timely to see the return on capital, but ultimately in the long run, it's a phenomenal strategy to both increase your cash flow revenues and value. But also, if you're bringing new homes in, it's going to spruce up that park. I mean, if you start bringing brand new homes in that have vinyl siding, shingle roofs that look like a traditional home to some sorts, it'll start changing the overall appearance of a older mobile home park that might have a lot of older units with metal siding and things like that, right? And so lots of benefits that come from doing that. However, again, it's, as I mentioned, it's very capital intensive and time consuming to do, to reach that high hanging fruit. But those are kind of like the three layers of value add that we look to get.
I like it. Okay. So obviously we've had the COVID-19 situation take place, right? So it's ongoing. This recording is taking place, early June. So for everybody listening out there, but it's still ongoing, right? Nonetheless. So how have your communities been impacted as a direct result of, unemployment? How are your collections? Tell us a little bit more about that. Give us a little bit more color on that.
Yeah, no, that's a great question. Going from like the second, third week of March into April, we were kind of, planning for the worst and I hoping for the best. I don't think anyone knew what that meant, right? Everyone was just trying to, prepare, not knowing how it would ultimately play out. And so April, we were very surprised. We ended up collecting by the end of the month. I think we're at 92%. And a lot of that, every state that we own in was different than the next. And so like, for example, New York and Florida completely screwed up their unemployment process. So there are a lot of folks that they had applied or they couldn't get through the system because it was just backed up, it was jammed up. And so a lot of folks that, would qualify for unemployment that had lost their job, ultimately couldn't get those funds. Right. And so April was not nearly as good as what May was. And so we caught up a good bit in May. So we closed out the month of May at 96%. And so we still have a few stragglers here and there that we've done a number of workout plans with. We're trying to work through. We ultimately don't want anyone to lose the roof over their head. And again, it's been state by state. We've had some states that have been like darn near 100%, and we've had other states that have suffered a little greater. Again, Florida and New York, naming two right off the bat. Maryland was another one where they kind of flubbed their unemployment process. And so I think the bigger barometer, this is for multifamily, this is for single family, this is mobile home parks. I think the bigger barometer is not these last 2 months, Juan. I think it's in all reality, it's going to be after July. It's going to be August and September, because those boosted unemployment benefits that the Fed, gave the additional $600, it runs out in July. And I think that that's when we're going to all see reality of, who just, I don't want to use the wrong terminology, but like somewhat milked the system. And now, there's lots of jobs that have not come back. And so like when they go to get a job, it's not going to be there. And the normal unemployment benefits, on a weekly basis are most can't survive on what they're going to receive after that additional $600 amount goes away. And unless the Fed comes in and actually does another stimulus plan, which I don't know if that's been in talks or not, I haven't really paid attention to it. But I think the real barometer is going to be here in August, September of how your business, my business, has truly been affected, and really what the unemployment rate is once companies that have gone away don't come back, or companies that have stayed downsize, right? They don't have as many positions left anymore, or positions don't even exist anymore due to the kind of the shift of going from in the workplace to working from a remote type of situation, right? So in any event, we fared really well. But I think time will tell. So
Yeah.
I don't know how you feel about that, but I think time, it's really going to be the remainder of the year is the telltale signs of how this really impacted us. These last few months I truly think are nothing.
Yes, and I'm with you 100%. I think that the majority of the communities out there, if they needed help, they got bailed out in one way or another through the stimulus checks, the unemployment. And I'm with you, right? So once it runs out, which is supposed to be in July, that's when you're gonna find out who was. What did Warren Buffett say? Who was swimming naked, or whenever the ride the tide is gone, you're going to see who was swimming naked. But
that's it.
I think just based off of what I've seen, Q3, Q4, we may be seeing some big changes. Which leads me to my next question: are you still in acquisition mode today, or are you not wanting to catch, for lack of a better term, a falling knife, right? Because maybe you're thinking that the prices will still have some room to drop, and that won't happen until Q4 or 2021, 2022. What's your mindset right now?
Yeah, that's a great question. I mean, we're not ones to sit on the sidelines. I think good deals can be had in times when prices are high, and good deals can be had when prices are low. I don't think that I don't know. I've never met the individual or heard of the individual that's ever truly caught the falling knife, or that hasn't caught the falling knife, that got it timed right at the bottom. It just doesn't really exist, right? And so I think as long as you're firm in your stance of what markets you feel very confident in, you're firm in your underwriting, and you don't try to just make a deal work to make it work. I think that there's good opportunities today, and there will be good opportunities a year from now. But I don't think that our spaces, our two niches, are going to take much of a pricing impact. I mean, it all depends on how they fare over the remainder of the year, and even going into 2021. I mean, if that changes drastically, then ultimately I do believe there would be some pricing impacts. But in short-term view, I don't think that's going to take place. And a couple major factors. Number one, collections were really good. Number two, agency debt is at an all-time low. I mean, so in fact, if anything, depending on the quality of the asset, if it's a prime asset that could qualify for Fannie and Freddie today, I think you might actually see prices drop a little bit, because the rates are just, literally, it's a once in a lifetime type opportunity.
They are.
As far as where rates are at. And so, again, time will tell. So to answer your original question, if we're in acquisition mode, we do a fund structure. We don't do individual deals. And so we closed out a fund. I think it was like end of third quarter of last year, and last year was a unique year for us. So we didn't buy a ton of opportunities last year, but what we did is we spent a good 8 or 9 months really honing our property management. So we do all our property management in house. We didn't, and that was a bad experience. And so we really built a robust property management company, and didn't want to keep putting fuel on the fire by buying more property. So we could have surely acquired a lot last year. We backed out of a lot of deals and didn't do a lot of deals that probably would have made sense. But we wanted to get our books, not our books in order, but just our house in order, and make sure that, number one, that we could efficiently take advantage of everything we already own, but also be prepared to double or triple in size and have the right business model in place to actually handle that and basically support that. And so that's what we did last year. We only bought one property last year. We just finished up documentation on rolling out our next fund, which is going to be it was supposed to be rolled out now, but the COVID thing kind of put it on the sideline just for a few months as we waited to see how this was all going to play out. But we've got a couple properties in contract as we speak now, and are really ramping up our pipeline. Are looking to have a good remainder of 2020 as far as new acquisitions are concerned.
Nice. I like it.
Yeah.
Before we jumped on the call today, also, we discussed another asset class that you're actually pretty bullish on. And actually, from my understanding, you have a couple under contract today. Mm-hmm. And that is, parking lots, right? Tell us a little bit more about that asset class, which is something that not many people talk about. You hear about multifamily all over the place. Mobile homes, not so much, at least from my experience, is not so much, but multifamily all over the place, single family all over the place, but not necessarily parking lots. So tell us why you like this asset class, and why you have a couple under contract.
Yeah, no, that's a great question. Yeah, so we'd been studying. I was introduced to that niche about 3 years ago, actually, on an interview I did, and I was intrigued by it from that first time I had heard about it and understood the business model and how it worked. Just like just like mobile home parks, they're not really building parking lots, not too often anymore. Most parking lots you see get built are basically like maybe a garage that's a part of a office building or part of a hotel, or part of an event center, right? Like it's actually attached to something else. It's not a standalone surface parking lot in a downtown area or in a beach town or a parking garage that's a standalone. And so there's a limited supply and there's big barriers to entry. Most municipalities, just like mobile home parks, they don't like surface parking lots. They think they degrade the area. And typically, when you're speaking to a parking lot that's in a central business district, right, like a downtown area, or it's in a tourist-driven location like a beach town, what have you, the value of it being a parking lot is typically going to be the lowest value ever. And assuming that it's in the path of progress or it's already there, there's more than likely always going to be a higher and better use. I mean, there might be a few circumstances where that might not be the case. And so our objective is to essentially be able to get in and, buy into an already existing cash flowing play, not with a plan of redeveloping it in the future. However, if that plays out, then knowing that there's a potential higher and better use, it's just kind of icing on the cake. But really, just looking for a nice, stable, sustainable, secure cash flow play on a prime piece of real estate. So just a long-term buy and hold strategy. One of the things that attracted me to that niche is when I got to understand how it operated was that, number one, it's very fragmented. So 70% of the parking lots out there, parking lot owners out there only own one. And so that to me means tons of mom and pops, right? There's some institutional, people in the space, but generally speaking, it's a lot of mom and pops. And
interesting,
a majority of the folks that are in the business, they don't own the real estate. And so if you actually go to any major city, you'll probably see some trends of, any parking lots that are being managed by a company. Most of those companies don't own the real estate. The underlying owner is someone completely different, probably a mom and pop. And so these companies typically will come in and they'll offer a 3, 5, 7, or 10-year fixed lease or a type of management agreement where they'll essentially guarantee a certain amount of revenue, and they make their money by the operations side, right? So they'll come in and take it over and manage the day-to-day, manage everything. And if you're talking about a surface parking lot, there's not much upkeep at all. I mean, a lot of times these are triple net leases. And so if there is any upkeep, like resurfacing the parking lot or signage or anything like that, that's typically written into the lease, or most of the time it can be. And so it's just a very hands-off type investment. I wouldn't say the returns are knock it out of the park, but it's very much a coupon clipper, that you're signing with an A credit operator. And so it's very bankable. Banks like it because you're basically signing, a long-term lease with an operator that's got a track record and experience. And so again, just a very passive covered land play for us in a niche that is very fragmented, that doesn't have a ton of competition. But our biggest competitor are developers. And so the idea is that to be able to get to a parking lot in an area that's growing, but not yet to where that parking lot already has a higher and better use, to where a developer will be willing to pay more for it as a redevelopment piece of land than what it's worth today from its current cash flow state, if that makes sense. That makes sense. Like finding that sweet spot right in the middle. So we, one of the parking lots we have in contract today is in a downtown area. I'm not going to mention because we're not closed on it yet, so I don't want to put it out there due to non-disclosures and things like that. But it's in a very hot downtown area in North Carolina. It's smaller. It's 29 total spaces. It's currently being managed by the son of the guy that owns it. He's a doctor in the area, and right now they're collecting on average. I think does about 40. I think it was like $45,000 of net revenue, NOI, a year. And we went to a local operator that knows that market. They manage, like 35 other lots in that area. And they basically are willing to write us an LOI at $70,000 a year with 3% increases, for 10 years. And we're having it under contract for $695. And so looking at it from what it's currently doing, it would not be a good deal at all. Looking at it from the LOI that they just wrote, it's a pretty solid deal. I mean, it's every bit of a 10 cap. I wouldn't say that's a norm, but there's a lot of parking lots out there that are very similar to that. Lots of theft that happens with mom and pop operated parking lots. If they've got their own person that's a parking lot attendant, they're collecting cash. I mean, everyone knows where that story goes, right? And that cash doesn't make it into the actual coffer. Lots of theft that occurs. And just, if the parking lot doesn't have technology, if it doesn't accept credit cards, which there's still parking lots that don't, right? They got the little honor box systems where you have to shove your dollars in. I don't even carry cash with me anymore. I literally never have cash on me. I just don't. And so there's a lot of missed opportunity and mismanaged parking lots, just like there are in your space and just like there are in mobile home parks. So anyway, long-winded answer, but we're excited about it. I don't know how much it's going to make up of our business, but we're going to buy opportunities as they come about, and we're aggressively building up a pipeline of deals that we'd like to take down here in the coming year. So excited.
That's another solid asset class. So
yeah,
I'm glad that you were able to share that with us as well.
If you don't mind, Juan, we actually just wrote an ebook as well. It's free on the parking lot space. Yeah, it's called parkinglotprofits.com. If you guys will have an interest, it's kind of like the top 10 reasons why we like the parking space. You can go download it. Again, it's free. We just wrote it literally in the last month. Again, parkinglotprofits.com. So if anyone has any interest whatsoever, go check it out. And not selling you anything. There's no coaching program for that. That's just just raw information of why we like the space.
Good. Yeah. I think everybody should download that for sure. Parkinglotprofits.com. Check it out. So, Kevin, it is time for our Nuggets of Wealth. And these are questions that I ask every guest every week, and hopefully they are able to help them out. So question number one is, what is a good tool, source, or platform that you use almost daily that can also help others?
Yeah, no, that's a great question. Zoom, or not Zoom. Zoom, I use that all the time. But Slack is a game changer in our business. Like 2 years ago, we instituted it, and it's just a phenomenal communication tool.
Okay, which book are you currently reading, and which one has had the biggest impact on your life?
Yeah, this is pretty funny. So this is kind of a joke. This is what I'm reading right now, but it's not normally what I would read. But and you're probably a little too young, Juan, to remember this movie. But it's called Rad. It's like a BMX movie that was like literally I probably rented it. My parents rented it for me 100 plus times from Blockbuster back when Blockbuster existed when I was a little kid. And anyway, it just had a big impact. I know a friend of a friend that actually knows Bill Allen, who was the main actor in it, and they sent me a book, and so I'm reading it now anyway. But I normally would be reading a business book or something like that. So
no, it's okay. It's okay. You have to switch it up every now and then. You can't just stick with business or anything like emotional or motivational. You have to switch it up a little bit, right?
For those that are listening that are probably 40 plus in age, know the movie Rad. If you're a male and you grew up riding a BMX bike, which probably most of you did, at least around the neighborhood, then you probably know that movie. So I'm sure there'll be some chuckles of folks that listen to the show that are at that age group.
That's awesome. So which book has had the biggest impact on your life?
Yeah, I mean, not to be cliche, but Think and Grow Rich was one of the first books that David, that guy, the mentor, he was a mentor. I mean, he didn't label himself that, but he gave me, he had always been into self-help and self-improvement, and he gave me like a stack of books, that he had already read, many times, and Think and Grow Rich was one of them. And he suggested I, put that in the first few that I'm going to read and spend time on. And I've read it. I don't know. I try to read like once a year, but by far has had the biggest impact on my life and business.
Love it. Okay. Do you have any rules for success that you live by?
Yeah, I think just, if we're talking about real estate here, it doesn't have to be real estate driven answer, but it's find out what you really enjoy doing, right? I mean, like the money will ultimately come, but like there's 1,001 different ways to make money in real estate. Find the path that is most directly aligned with you as an individual, your philosophy on life, your philosophy on business, on family, what have you. I mean, there's certain types of real estate that are very time consuming. There's certain that are very passive, and allow you a lot more freedom and time. But, really focus on what you enjoy doing and what will ultimately help you achieve your personal and your life goals, right? Like what type of real estate is that? Is it, maybe it's mobile home parks, maybe it's multifamily, maybe it's none of those, right? Maybe it's actually just being a limited partner and being a passive investor. Anyway, again, just really focus on who you are as an individual, where you want to be, and what best aligns with your own interest. And so otherwise you can make money, but if you're not happy making the money, you're going to get burned out and you're going to get resentful at some point.
I agree. So Kevin, how do you like to give back?
Yeah, so I'm a huge believer in helping others. I mean, so the podcast, I've got 2 different podcasts I've been doing for a long time. I enjoy giving back in that manner. I do a lot of speaking engagements, things like that. But, about 10 years ago, actually, this will be our 10th year, I started the biggest endeavor of like where we actually donate a substantial amount of money. I started a charity bike ride, bicycle ride 10 years ago where we go fairly long distance, like a 280-mile bike ride over 3 days. It's just, we invite 75 people from all across the country every year, and all the proceeds go to 2 local charities that are near and dear to my heart. And so every year we donate anywhere between $45,000 and about $60,000 to these 2 different charities. Again, it's all about aligning like your own interests and what you enjoy doing with, what it is you want to do in life and business, what have you. And so like I enjoy cycling. And so I was like, you know what, I enjoy doing this. And so how can I give back by what I love doing? And ultimately it turned into a bike ride that sells out every year. We've had, now thousands of people that have done it, and it's a great way to have fun and also, again, help many, many others in the process.
Awesome. Yeah. I like biking. That's something that's actually something more recent for me. We did the MX150 last year. I signed up for it this year as well. I think it's a great cause. But in the process, I just found that, you're able to push yourself. It's a long distance. You're able to push yourself, and you have just a bunch of great people around you as well. Yeah. So I think any kind of activity like that is just great. Last but not least, Kevin, at the end of your life, how do you want to be remembered?
Yeah, I want people to, when they think of me, I want to think of what positive impact I had in their life. I mean, whatever that means, right? I want them to remember me for something positive, how I might have helped them maybe find a path to financial freedom, or I don't know, or just help them in just being a friend and listening, what have you. But I want everyone to remember me as someone that gave back to society and left the world a better place than what it was prior. So simple as that.
Got it. Okay, good. So where can Commit to Wealth Nation go to contact you and find out more about you and your company as well, Sunrise Capital Investors? Yeah,
so you can go to my personal website, kevinbupp.com. There's multiple links there of the different things that we've got going on, and then our company website is sunrisecapitalinvestors.com. And if anyone has an interest in the Key West bike ride I'd mentioned, they can find it on my website, but they could also go directly to that website. It's called 72hourstokeywest.com. And if they have an interest, they're feeling adventurous and they'd like to join us this November, please check it out. And we've got people from all over the country come and join us. And you end up in sunny Key West, Florida, which is a pretty cool place. So it's a fun ride.
Love it. Yeah, you guys need to check it out for sure. Okay, well, Kevin, it was a true pleasure to have you on. I think that I think just your story, right? It felt more of a conversation than an actual interview to me. So I really like just all the value that you're able to provide for myself, but also to my audience, right? So a lot of good things that you provided here for us. So I want to thank you for that. I really do.
Thanks for having me, Juan. It's been a lot of fun, and thank you for all you do for the real estate world and just giving back with your time and energy and education, man. It's awesome.
CommitToWealth.com, creating a legacy by committing to real estate wealth.